So, if you want to know how the American economy is actually doing right now, honestly, ignore the Federal Reserve.
Right.
Ignore the monthly jobs report. You need to look instead at who is currently pushing a shopping cart down the aisles of a Dollar General.
Yeah, that's the real ground truth.
Exactly. Because right now, their fastest growing customer base isn't, low-income earners stretching food stamps. It's actually households making over $100,000 a year.
Which is just wild.
Yeah.
I mean, it completely inverts our traditional understanding of the retail hierarchy, right?
Oh, absolutely.
We're so conditioned to view discount retail as this isolated economic sector, like a place for a very specific financially constrained demographic.
Mm-hmm.
But when the six-figure earner starts hunting for $1 deals, well, you realize the macroeconomic pressure we've been talking about is altering consumer behavior across the entire socioeconomic spectrum.
It's a massive shift. So, welcome to today's deep dive. If you're an investor trying to figure out where the consumer is at, this is for you. We are taking a magnifying glass to the Q1 2026 earnings call transcript for Dollar General, ticker symbol BG.
DG, yep.
And our mission today is to decode this retail giant's performance. Because like you said, we want to understand the current state of the American consumer.
Yeah, these earnings calls, they're basically hidden treasure maps for retail investors.
Totally.
You get past all the, corporate preamble, and you find the raw data of how millions of people are actually allocating their capital week to week.
And the central irony here, the dynamic that makes this specific deep dive so fascinating, is that at a time when people undeniably have less discretionary income, a discount retailer like Dollar General is seeing a surge in foot traffic.
Right. You'd think less money means less shopping.
Exactly. You would intuitively think less money in the economy means less shopping everywhere. But people aren't necessarily shopping less. They're just shopping differently.
They're redirecting their capital out of necessity.
Okay, let's unpack this. Because to grasp the sheer scale of what's happening, we need to look at the scoreboard from this first quarter.
Let's do it.
The headline numbers here are not just strong. I mean, they are staggering. Net sales increased 3.4% to $10.8 billion.
Wow.
Yeah. And that is just for a single 13-week quarter.
Right. And when you're dealing with a mature company operating over 21,000 stores, generating a 3.4% top-line increase to reach nearly $11 billion, that's a massive logistical feat.
Definitely.
But the bottom line is even more revealing for anyone holding the stock. Their earnings per share, or EPS, jumped 12.4% to $2.
Which beat expectations, right?
Oh yeah. The transcript explicitly notes that this beat the company's internal expectations. They exceeded the high end of their own guidance framework.
So the people running the company were genuinely surprised by the sheer volume of demand.
Yeah, they really were.
And when we look under the hood at the mechanics of that growth, same-store sales grew by 2%. And as investors, same-store sales is the ultimate metric of a retailer's health.
Because it strips out the growth from simply opening new locations.
Exactly. But that 2% is made of two very distinct parts. It was fueled by a 1.4% growth in customer traffic and only a 0.5% growth in the average basket size.
And this is where the story really begins. That traffic growth marks the fourth consecutive quarter of increased customer visits.
4 quarters in a row.
Yeah. And in the current retail environment, getting a consumer to leave their home, spend money on $4 a gallon gas, and physically walk through your doors, that is the single hardest metric to move.
Well, and what's wild about these numbers is the context of how this quarter actually kicked off, because the first 2 weeks of February were a total nightmare.
Oh, the weather, right?
Right. The CEO, Todd Vasos, noted that severe winter weather forced thousands of temporary store closures. Thousands of stores were quite literally frozen shut.
And you can't generate revenue if the parking lot is a sheet of ice.
Right. So they started the quarter totally in the hole.
Yeah.
Negative comps for those first 2 weeks.
But a quarter is a marathon, not a sprint. For the remaining 11 weeks, the business roared back so intensely that sales trends hit the upper end of their target range.
It's like a sports team getting shut out in the first quarter due to rain and then coming back to win by a blowout.
Yeah, and to rally the transportation fleet, the store teams, the warehouses, to recover from a freeze like that and blow past projections, it shows a highly optimized machine.
But okay, let me push back on something here.
Sure.
If traffic is up 1.4%, but the basket size is only at 0.5%, doesn't that mean people are coming into the store more often but buying slightly less each time?
Yes.
So my cashiers are working harder, but the revenue per transaction is virtually flat. Is that actually a good thing for a retailer?
In a constrained economy. Absolutely. Yeah. Frequency is the ultimate currency of loyalty.
Okay, how so?
Think about the friction of modern retail. Gas is expensive, time is limited. If a consumer's budget is super tight, they physically cannot afford to buy a massive bulk basket all at once.
Right. They can't drop $300 at Costco.
Exactly. They are buying exactly what they need for the next, 4 days. So the basket stays flat, but the visits increase. And securing that recurring visit means you own the relationship.
So if you lose the trip, you lose the customer. But if you have the traffic, you have the opportunity.
Precisely. If they're in your store 3 times a week instead of once, you have 3 distinct opportunities to expose them to new merchandise.
Impulse buys, seasonal items.
Yeah, exactly. You can eventually grow a basket over time, but you cannot manufacture loyalty out of thin air. Capturing the habit of the trip is everything.
Okay, so they're capturing the traffic, but the immediate question for investors is, who is actually making those visits?
Right.
Because the data inside this transcript kind of shatters conventional wisdom about the discount retail demographic. It shows 2 very different economic realities colliding in the exact same aisle.
We have to start with what management calls the core customer.
Right, the foundation. And the core customer is facing immense pressure right now. The CFO, Donnie Lau, was pretty sobering about this.
Very. He pointed out that whatever temporary benefit they got from early-year tax refunds was instantly vaporized by fuel prices.
Gas is sitting at or above $4 a gallon in so many markets right now.
And that's highly regressive. It hurts someone making $30,000 exponentially more than someone making $130,000.
It just devours their disposable income just trying to get to work. Plus, this core customer is actively dealing with reductions in 2026 SNAP benefit payments.
Yeah, food stamps. The actual federal dollars circulating in these communities are down.
But here is a super counterintuitive metric from the call. Despite that drop in overall SNAP dollars, Dollar General actually grew its share of wallet with SNAP customers.
Wait, really?
Yeah. It means that while these individuals have fewer assistance dollars overall, they're choosing to spend a much larger percentage of them at Dollar General instead of a regular grocery store.
Oh, wow. That just proves that when budgets are slashed to the bone, a local discount store goes from being a convenience to a survival necessity.
Totally. The CEO even noted that core customers are cutting back on other essentials, even basic food, just to afford gas.
And in rural communities, that pressure is magnified. You have to drive further for everything. So a store right in your neighborhood is a vital resource to save on miles.
But here's where it gets really interesting.
Okay.
We have the constrained core customer, but then we have what Dollar General calls the trade-in customer.
Right, the higher income shopper.
Exactly. The transcript states that the absolute largest increase in customer count came from households earning more than $100,000 annually.
Which is a crazy stat. And it forces DG to walk this dual strategy tightrope.
How so?
Well, they have to cater to the rural, low-income customer who runs out of money before the end of the month. But simultaneously, they have to appeal to the 6-figure suburbanite who is trading down from Whole Foods to save money on paper towels.
It's like people who usually fly first class suddenly booking basic economy because their budget got squeezed.
Yeah, that's a perfect analogy.
They find themselves sitting next to someone who has flown basic economy their whole life. Same plane, same flight, vastly different economic journeys.
And that $100,000 earner, they're highly rational. They might still have a good job, but inflation has eroded their purchasing power.
$100,000 today just doesn't buy what it did 5 years ago.
Exactly. So they realize there's zero prestige in paying a 30% premium for laundry detergent at a high-end grocer. They want structural value.
But, and this is where investors might get nervous, won't those 100K plus shoppers immediately abandon Dollar General as soon as inflation cools and gas prices drop?
It's the obvious question.
Right. Like, how can DG build a long-term model on temporary economic pain? Once things get better, won't the first-class flyers sprint right back to first class?
Wall Street analysts asked the exact same thing on the call. But management isn't just, passively hoping they stick around.
What are they doing?
They're executing aggressive retention strategies, targeted marketing, utilizing loyalty programs specifically to capture these trade-in customers permanently.
So trying to build a habit.
Exactly. Habit formation.
Yeah.
The 6-figure earner comes in because of $4 gas. That's the acquisition.
Yeah.
But once inside, they see the store is clean, checkout is fast, and the non-consumable items are actually really nice.
So they want to break that psychological stigma of the discount store.
Yeah. They want that customer to eventually say, why would I ever go back to overpaying?
Okay, so we've got the $100 suburbanite and the core rural customer standing in the exact same aisle. How do you convince both of them to actually open their wallets?
You anchor your strategy on the psychology of a single piece of paper, the $1 bill.
The power of $1. The transcript highlights they have over 2,000 individual items priced at or below $1.
Which, in an era where a fast food burger is $10, is a supply chain marvel.
Right. And the crown jewel is their Value Valley program. Over 500 rotating items, all strictly $1. And in Q1, Value Valley saw an explosive 18.4% comp sales increase.
Generating 18.4% growth on a mature program like that is phenomenal.
Driven largely by health and beauty, according to the CEO, and they're doubling down. They introduced a brand new physical asset in the stores, a full freezer door dedicated entirely to $1 items.
Now, this is brilliant because the psychological utility of that $1 price point shifts completely depending on the day of the month.
Walk us through that. How does the psychology change?
So early in the month, when the core consumer still has some cash or SNFP benefits, the $1 item is an impulse add-on, a little treat.
Right, it's just a buck, low friction.
Exactly. But in the final week of the month, the psychology inverts because the money is simply gone.
That is so stark.
It is. The core customer frequently runs out of money before the month runs out. Yeah. So those final days, that $1 item isn't a treat anymore. It transforms into a budget bridge.
A budget bridge.
Yeah, it becomes a survival mechanism. If you only have $12 to feed your family until Friday, you're piecing together calories. That $1 frozen pizza lets you micro-budget to survive until payday.
Man, that perfectly encapsulates the reality of the consumer squeeze right now.
It does.
Yet, that exact same $1 pizza works for the high-income trade-in customer too, just for a totally different reason.
For them, it's the dopamine hit of the treasure hunt.
Right, the thrill of finding a deal, like a video game mechanic.
Exactly. It validates their choice to shop there. And remember, DG calibrates its everyday pricing to stay within 3 to 4 percentage points of the big, massive retailers, like Walmart.
So you never feel gouged on the standard stuff.
Exactly.
But this brings us to their non-consumables. Toys, home goods, seasonal decor. Because while they come in for the dollar item, they end up buying the discretionary stuff. And non-consumables saw a 4.6% increase in Q1.
A fifth consecutive quarter of positive growth there. And that is the holy grail for discount retail.
Because the margins are so much higher than on a gallon of milk.
They're massively higher.
And they launched new brands, like a home category partnered with Holly Williams, following up on the Dolly Parton partnership.
Creating that joy of discovery. You go in for a $1 shampoo and stumble on a really nice, trendy, decorative pillow.
But wait, let me be the skeptical investor for a second.
Go for it.
How do you make any real profit selling a frozen pizza for literally $1 in 2026? Think about it. You source the materials, manufacture it, put it on a refrigerated truck burning expensive diesel, pay the driver, pay the staff, run a glass freezer 24/7.
Doesn't the sheer cost of packaging and shipping wipe out the margin?
Exactly. How is that not a loss leader?
Well, if you look at the $1 item in isolation, the unit economics are pretty disastrous.
Right.
The margin is microscopic. But DG's entire financial model relies on the halo effect.
The halo effect. Let's break that down.
The dollar item is not the profit engine. It's the customer acquisition tool. It gets you through the front door. Because to get to that freezer in the back, you have to walk past the seasonal displays, the toys, the Holly Williams decor. And the statistical probability is that you end up tossing a $12 high margin item in your basket alongside the $1 pizza.
So the dollar item subsidizes getting them in the building, and the home decor provides the actual operating profit.
Precisely. The CEO said they don't even stress if the average basket size shrinks slightly, as long as they deliver that extreme value.
Okay, so that leads us directly into the financial mechanics, because if you're holding DG stock, you care about margins.
Absolutely.
How are they actually expanding margins while absorbing all these macroeconomic costs? Because gross profit actually increased by 65 basis points in Q1. It hit 31.6%.
Which is incredibly impressive in this climate. And that 0.65% expansion on $10.8 billion in sales means tens of millions of dollars flowing straight to the bottom line.
And it wasn't a fluke. The CFO attributed it to lower inventory damages, higher markups, and most importantly, lower shrink.
Shrink. Yeah, that's the word everyone in retail is terrified of right now.
Right. Retail theft, damaged goods, inventory that just vanishes. You go to a pharmacy and toothpaste is locked behind plexiglass.
But amidst this national crisis, DG reduced shrink by 28 basis points versus the prior year.
And that's on top of an 80 basis point improvement in 2025. They are structurally getting better at preventing loss.
It flows right into gross margin. Plus, their store-level execution is highly disciplined. Associates aren't crushing boxes, they're rotating perishable stock.
And speaking of stock, total merchandise inventory was $6.6 billion. That's effectively flat year over year, and actually down 1.6% on a per-store basis.
Which is a masterclass in capital efficiency.
Because they're growing sales by 3.4% while holding inventory flat.
Exactly. Excess inventory is a suffocating liability. It ties up cash, clutters stockrooms, causes damages. By running tight, they generated $716.2 million in operating cash flow in one quarter.
Over $700 million in cash flow. And the big secret here is SKEG rationalization. The transcript says they actively removed about 1,200 SKEG individual items from their stores over the last couple of years.
This is such a fascinating mechanic.
So what does this all mean? I kind of look at it like cleaning out a cluttered closet.
Yeah, good analogy.
If you have 50 t-shirts jammed in a drawer, it gets stuck. Clothes get wrinkled. But if you purge it down to your 20 best shirts, you have space to breathe. DG looked at their shelves and said, "We don't need 10 types of peanut butter. We need the 3 that actually sell."
Exactly. When you remove 1,200 SKUs, you eliminate the need for a warehouse worker to slot it, pallet space on a truck, and the labor to stock it. Multiply that by 21,000 stores, and it's hundreds of millions in saved logistical friction.
But if you remove 1,200 items, aren't you risking alienating a loyal customer who comes in for their specific obscure brand of shampoo?
You'd think so, but in retail psychology, there's the paradox of choice.
Overwhelming choice leads to decision fatigue.
Exactly. The efficiency gained by simplifying the store vastly outweighs the loss of a few niche shoppers. The core customer wants value and convenience, not an endless aisle of variations.
Okay, but simplifying the physical store is only half the battle. To keep that $100 plus shopper, you have to beat the e-commerce giants.
And this is where the narrative of DG being just a humble rural store completely shatters.
Let's talk digital. Delivery contributed a massive 70 basis points to the 2% comp sales growth. People are ordering from their couches.
And the delivery speeds are insane. 80% of orders are delivered in under an hour.
And 40% in under 30 minutes.
Right.
I can barely get a pizza in under 30 minutes in the city. How are they doing this in rural areas?
It's all about real estate. DG has 21,000 stores located within 5 miles of 75% of the U.S. population.
75% of the country is within 5 miles of a DG.
They are secretly operating an incredibly dense last-mile logistics network. Every local store is a micro-fulfillment node.
And they're piloting a delivery subscription program later this year.
A recurring revenue stream that locks consumers into their ecosystem.
But the real margin expansion is the DG Media Network, right?
Oh yeah, they're targeting 50 basis points of margin expansion just by selling ad space.
Sponsored search results on the app, in-store radio ads. Big brands like Coke or Procter & Gamble are paying DG to advertise right at the point of purchase.
Which is near pure profit for Dollar General.
And they're building an AI operating system for the enterprise to reshape workflows. It makes DG sound like a Trojan horse.
It really does.
On the outside, it's a discount box with yellow letters. Inside, it's a high-speed logistics, retail media, and AI empire. But honestly, does the typical rural core customer actually care about AI and digital media? Or is this just corporate jargon to make Wall Street happy?
The customer doesn't care about the jargon, no, but they rely on the outputs. They don't see the AI, they just see that their $1 budget bridge item is always in stock.
Because the AI predicted the local demand.
Exactly. And the media network. The rural shopper doesn't care about ad revenue, but that highly profitable revenue subsidizes Dollar General's ability to keep basic prices low.
The big brands are essentially paying for the discount.
Precisely. The tech pays for the discount.
Which means all this cash flow fuels physical expansion. Let's look at the 2026 outlook, because if you're an investor, this is the guidance you care about.
Management is super confident. They actually raised 2026 EPS expectations to $7.20 to $7.45.
And net sales growth expected to hit 3.7% to 4.2%. They're planning 450 new stores this year.
But it's not just new stores. It's the remodels.
Right. Project Renovate and Project Elevate. 2,000 full renovate remodels yielding a 6% sales lift. They're adding fresh and frozen food coolers.
Because if you add fresh food, you turn a convenience trip into a primary grocery destination.
And 2,250 Elevate remodels yielding a 3% lift. It's like upgrading a smartphone operating system. You get a performance boost from the same hardware.
That reinvestment secures their long-term goal of 6% to 7% operating profit.
And they're going international, expanding Miss Super Dollar General stores in Mexico, aiming for 10 new stores this year, bringing the total to 21.
The economic similarities between rural American consumers and the emerging Mexican consumer class make it a very logical test lab.
But with all this expansion, new U.S. stores, massive remodels, Mexico, AI, 30-minute delivery, is there a risk they're taking their eye off the ball in rural America?
Well, growth always carries execution risk. But DG's mature store base inherently requires this capital reinvestment to prevent decay. If they don't remodel, the stores get dilapidated and they lose customers to competitors.
It's defensive and offensive.
Exactly.
Yeah.
And Mexico is a relatively inexpensive experiment for a company of this size.
Wow. Okay, we have covered so much ground today. To quickly summarize for our Talk Tickers listeners, Dollar General bounced back from a terrible February to deliver a massive quarter.
Yep.
They're serving the struggling core customer with a budget bridge and capturing the wealthy trade-in shopper hunting for value.
All while magically expanding margins, shrinking inventory, and speeding up delivery.
So I want to leave you, the listener, with a final provocative thought.
Yeah, think about this. If Dollar General is seeing its fastest customer growth in the six-figure income bracket, and they're moving heavily into one-hour delivery and retail media networks, at what point do we stop calling them a discount retailer entirely? At what point do we recognize them as a direct competitor to the biggest e-commerce and grocery titans in the world? As inflation reshapes habits, the definition of a general store is evolving right before our eyes.
That is such a fascinating point. The lines are blurring permanently. If you're looking at DG stock, you have to look way beneath the surface of the headlines. Thank you for joining us on this deep dive, and we'll see you next time.